Hey everyone, and welcome to today's Explainer. I am absolutely thrilled you're here. Today, we're going to completely demystify the somewhat intimidating world of high finance and mega IPOs. If you've ever watched financial news and just felt totally overwhelmed by jargon like book building, underwriting, or embedded value, well, you are definitely in the right place. We're going to break all of that down and make it crystal clear by looking at one of India's biggest, most historic financial events ever.
Okay, let's dive into this. Here's our roadmap for today. Number 1, savings versus investment banking. Number 2, due diligence as your shield. Number 3, the giant itself, the LIC IPO. And finally, number 4, the core lessons for everyday investors.
So, starting right off with Section 1, savings versus investment banking. To really grasp high finance, think about the regular bank branch you probably walk or drive past every single day. That local branch is a commercial bank. Its model is beautifully simple, right? Deposits in, loans out. It accepts your savings, keeps them safe, and lends them out for personal or business loans. It's really just a safe storehouse, focused on ongoing, long-term relationships with everyday people. But an investment bank? Well, it's a totally different beast. An investment bank doesn't take your deposits. Instead, they act as a high-stakes, project-based matchmaker. They help massive corporations and governments raise huge amounts of capital from the markets. They advise on corporate mergers and generate the revenue through fees and trading. So they deal in massive projects, not everyday checking accounts. And this concept brilliantly illustrates what an investment bank actually does. Think of them as the ultimate bridge. On one side, you have the capital providers, investors, funds, banks, maybe even you, folks who have money to invest. On the other side, you've got capital users, the corporations or governments that desperately need that capital to actually do things, like build national infrastructure or expand a business. The investment banker sits right in the middle. Their job is to advise, to price, to structure, and distribute those securities so that the capital flows safely from the providers over to the users.
Which brings us to Section 2, due diligence your shield.
So we know there's a bridge, but how do we make sure it's not going to collapse the second we step onto it? It's a very serious question. When a company asks the public for hundreds of millions or even billions of dollars, how do you, as an everyday retail investor, know your hard-earned money is safe? You obviously can't just fly out and personally audit their factories or read thousands of complex legal contracts yourself. You need a shield.
That shield is what we call due diligence. Before an investment bank lets any company cross that bridge and ask you for money, they act as the ultimate gatekeepers. They run through a really rigorous checklist. First up is financial diligence. This means they ruthlessly scrutinize the company's earnings, their cash flows, working capital, basically making sure the math actually adds up. Second is legal diligence. They check every contract in force, making sure there aren't any hidden lawsuits or regulatory landmines waiting to blow up. And third, operational diligence. This is reviewing the actual reality of the business. Are their supply chains robust? Do they truly have the technology they claim to have?
Now, if you're thinking this just sounds like a bunch of boring paperwork, well, history tells us a very different story. Back in the 1990s in India, there were numerous terrifying instances of vanishing companies. Unscrupulous promoters would hype up a company, launch an IPO to grab public money, engage in what's known as a pump-and-dump scheme with shady brokers, and then, poof, literally disappear into thin air. When the shield of due diligence fails or gets bypassed, common investors lose everything, and the entire market's reputation takes a massive hit.
To prevent those literal nightmares, we have a strict legal requirement. The result of all that exhausting due diligence gets poured into a massive, legally binding document called the Red Herring Prospectus, which is strictly governed by the regulator, SEBI. Think of this document as the company's ultimate, legally verified resume. Every risk, every single financial detail, every lawsuit, it is all laid bare. Investment bankers and legal advisors meticulously draft and vet this document because its absolute accuracy is the bedrock of investor trust.
Let's move to and see how this builds in Section 3, the giant, the LIC IPO. Let's take these core concepts of the bridge and the shield and apply them to the real world. In May 2022, the government of India launched the initial public offering for the Life Insurance Corporation of India, or LIC. The issue size was a staggering 21,000 crore rupees. That's roughly $2.7 billion. And the crazy thing is, this was just the 3.5% stake being divested by the government. A transaction of this mammoth scale simply couldn't be handled by just one bank. It required an absolute army. 10 book-running lead managers, top investment banks like Kotak, Goldman Sachs, and Access Capital had to join forces just to build this specific bridge.
Now, what's really interesting about this is the sheer complexity of pricing it. I mean, every Indian knows LIC. It's a household name with millions of policyholders. But before the IPO, it was a statutory corporation wholly owned by the government. That meant its immense financial strength had never actually been subjected to market-based price discovery. These banks had to figure out how to value a giant with a super complex actuarial structure and an embedded value of 5.4 lakh crore rupees. An embedded value is essentially a special metric, calculating the present value of all its future profits. They had to figure all of this out while balancing the government's fiscal goals with the harsh realities of the market.
And the investment banks couldn't just throw out a price and cross their fingers. They had to guarantee it through a process called underwriting. Underwriting is essentially a firm commitment. The investment banks promise that if the public doesn't buy all the shares, the banks themselves are on the hook to buy the unsubscribed portion. Remember, in 2022, the markets were incredibly volatile. We had global inflation, geopolitical tensions like the Russia-Ukraine war. So the underwriters acted as crucial shock absorbers, taking on massive personal risk to ensure this historic national event didn't just fail. To make sure the IPO succeeded and to protect everyday people, the bankers went with a deliberately conservative pricing strategy. While institutional investors paid the final price of 949 rupees per share, the structure was specifically designed to democratize the capital markets. Retail investors got a 45 rupee per share discount, and the millions of loyal LIC policyholders, they received a 60 rupee per share discount. This wasn't just about maximizing the government's profit. It was a highly strategic move by the investment banks to ensure broad, safe participation for everyday folks. Wrapping up with Section 4, Lessons for Everyday Investors.
So what are the big takeaways from all this? Well, the LIC IPO teaches us 4 absolutely vital lessons. First, we saw that underwriting isn't just a basic contract, it's deeply strategic. The banks had to carefully balance market capacity with government objectives right in the middle of a global crisis. Second, conservative pricing is a huge virtue. By not overvaluing the stock, they ensured long-term market credibility and protected retail investors from a disastrous collapse. Third, investor education is essential. With complex metrics like that embedded value, the detailed disclosures in the red herring prospectus were vital for helping normal people understand exactly what they were buying. And finally, transparency is the ultimate defense. Thorough, rigorous due diligence is the only thing that allows a massive public offering to withstand extreme market volatility and intense public scrutiny.
So here's the crucial point. The financial world isn't just some giant casino of numbers. It is supported by massive bridges built by investment banks and guarded by the ironclad shield of due diligence. I want to leave you with this question. The next time you consider a big investment, whether that's an IPO, a mutual fund, or even a bond, how will you evaluate the shock absorbers and the due diligence that are in place to protect your hard-earned money? Knowing who built the bridge and exactly how thoroughly it was tested is your very first step to becoming a truly empowered investor. Thank you so much for joining me on this explainer today. Stay curious and keep learning.